Okay, thanks for that, Jayesh. Mr. Kamakodi now joining us, MD and CEO at City Union Bank. Mr. Kamakodi, thanks for being with us. Wanted to understand first your outlook on asset quality, where the concerns are, where you feel things may look a bit more robust.
We are able to see improvement in the performance and operations of the various borrowers and businesses over a period of time. In fact, when we shared the results for the first quarter, in fact, we shared about 70% of the accounts were able to, let's say, repay loans as if there was no moratorium and things like that. And we were also able to see the total number and the quantum of transactions coming back to about 85% level of the pre-COVID. So initially, when the lockdown started somewhere in April and May and all, things were looking a little bit scary, and we were expecting things to come back to about 80-85% of the pre-COVID level only in the December or so. But the provision of ECLGS schemes and things like that have preponed by about at least 2-3 months, and we are able to see the activity level almost closer to the pre-COVID level now, and things are not as bad as originally what we thought, and able to see, and also it is getting matched with your other GST collections and other parameters also.
Okay, what's the outlook on slippages, credit cost, ROA? What are you looking at for FY21?
In fact, we had shared in the earlier, like say, meetings and also con calls with the investors. Typically, up to financial year 18-19, we used to have a slippage ratio of about 2 to 2.25%, which for the financial year 19-20 increased to about 3.25%. For the current year, we in fact we shared our expectations as somewhere between 3 to 3.5% slippage. And also overall, let's say in return on asset terms, we used to have about 1.5% up to the financial year 19. And for making extra provisions for the COVID for the financial year 19-20, we closed the year with 1%. And as we shared earlier, we hope, let's say, the ROA will stabilize only from the second half of financial year 21 and 22 and started moving upwards. And we will be reaching the pre-COVID level ROA of 1.5%. Our expectation is that it could happen only from the second half of financial year 22 and 23, as we had shared earlier.
Okay, Mr. Kamakodi, what about the corporate segments? Because it does seem that, SMEs are deleveraging. What is the outlook for the corporate book, both for large as well as SME?
Basically, what we are able to see is that almost, let's say, 90-95% of the businesses have come back to that, may not have come back to the pre-COVID level in terms of the turnover and profitability, but they have almost reached the break-even, except those activities and businesses like the hotels, the transportation sectors, the retail trades and all. These sectors are expected to have a longer gestation period, and they may be coming back to the pre-COVID level maybe in the next 3-4 months, maybe in the fourth quarter. All other businesses have, by and large, let's say, come back to the break-even level, and also to the extent of making payments to the banks. Maybe about 5% of them may need restructuring by it could be both corporate and also SME. Overall, things are looking much better and not as bad as it was originally anticipated during the beginning of the COVID lockdown.
Okay. And what has been your recent collection efficiency?
We will be giving the exact details along with our fourth quarter results. In fact, as I just informed you, even during the first quarter results, we had declared the accounts catering to the exposure of not less than 70% had made repayments as if there was no moratorium. And after that, the things are improving, and exact detail we will be publishing it to the market at large along with our second quarter results, which is expected in the next couple of weeks.
growth are you targeting for the coming years?
We expect for the current financial year, like say the growth between, like say, higher single digits between 5 and 10%. In fact, even before the COVID, we had declared during the December quarter results that we were not pushing the pedal for growth because the environment was not conducive at that point of time. Currently, after the COVID, like say, bulk of our incremental exposures are happening through gold loan and ECLGS loans, and only after, like say, the taking care of the existing customers through the release of ECLGS loans, and also through wherever required, providing the restructuring and all. We will be pushing the growth. Till that time, we expect our growth rate for the current year to be in the higher single digits between 5 to 10%.
All right, Mr. Kamakodi. So just to sum up, then overall, how would you really peg, let's say, the forecast for the upcoming fiscal? Do you feel it's too early to tell? Are you sounding cautious? Are you sounding optimistic? Just to sum it up for us, how would you like to leave it?
We can definitely 100% say that things are slowly becoming positive. In fact, like say, much better than what every one of us were expecting during the initial period of the lockdown, somewhere in the, like say, April or May. Even in the first quarter, we were able to see things improving, and after that, it is improving stage by stage. So the only expectations are that, like say, the Diwali consumption has to pick up, which will have potential to accelerate the consumption and probably even prepone by maybe a few months the time period required to get back to the pre-COVID level. And overall, the things are very much slowly and steadily getting into the positive mode. And we are able to corroborate that with the anecdotal evidences and other data points which are being published, like your GST collection or toll collections and things like that. So and at the same time, I think we have to also keep in the mind that, like say, there should not be any second wave which asks for another lockdown, or hopefully, I think those things may not be there. And apart from that, like say, the border situations and things like that, these sort of uncertainties are there, but they look to be, the probability seems to be very less. But overall, with respect to the COVID, things are much better than what all of us anticipated and prepared ourselves for. And hopefully, the good days will be back again much faster than what we originally anticipated.
Joining us then, Mr. Kamakodi. We're going to leave it there. We're going to take a very quick break. When we come back, we'll also take a closer look at Jet Airways, the resolution plan, what it will mean. Ashish Acharya will be joining us after.